Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Watts Water Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. Watts Water Technologies. They operate in the miscellaneous fabricated metal product sector, which sounds a little dry.
It does, yeah. But there's so much more than just a parts maker.
Exactly. This is really a structural play on water safety, on quality, and on compliance. And their performance lately. Yeah. Well, it really shows why they're a leader.
And when you say performance, we are not talking about small incremental gains here.
Not at all.
We're talking about a serious acceleration. I mean, their Q3 2025 results were just exceptional. Net sales shot up to $611.7 million.
Which is a 13% reported growth year over year.
13%.
Yeah, and that headline number is strong, but the nugget that analysts, really dig into is the 9% organic growth inside of that.
Right. Because that strips out acquisitions and currency effects.
Precisely. And for a company in, let's call it, heavy infrastructure, 9% organic growth is just stellar. The real question is, where does that come from?
Is it more volume, or are they just charging more?
It seems like a healthy mix, but that pricing power, that is a clear strategic advantage for them. They have the brand, they have the certifications.
So they can maintain that premium price.
And it flows directly to the bottom line. That's what makes this story so compelling.
And it shows in the earnings. They've built this pattern of consistently beating analyst expectations on earnings per share, or EPS.
Right. It happened in Q2 and again in Q3 of 2025. It speaks to really disciplined execution.
That Q3 adjusted EPS was $2.50. That's a 23% jump from last year.
A 23% increase? I mean, that's not just selling a few more valves. That points to some serious operational leverage.
Where the revenue growth is just crushing the growth in costs.
Exactly. And we see that leverage reflected very dramatically in their operating profitability. The adjusted operating margin for Q3 hit 18.5%.
Which, for context, is an expansion of 140 basis points over last year.
In a sector where input costs, metals, components, they've been all over the place. To get that kind of margin expansion, it just shows their sourcing and their cost management is really paying off.
That discipline is also what allowed them to raise their full-year guidance for 2025. But I did notice a little bit of caution in their language. They raised the bar, sure, but their organic sales forecast still includes a range from -3% up to +2%. If things are so good, why the hesitation?
I think it's just prudent realism. Their products are essential, no doubt, but their end markets, think new construction, big industrial projects, they're very sensitive to interest rates and any kind of macro slowdown.
Okay, so they're saying we can control our own house, but we can't control the global economy?
That's it exactly. They're controlling what they can control.
Which makes the signal they sent to shareholders even more powerful.
You're talking about the cash flow.
The cash flow is a fortress. $216 million in year-to-date free cash flow. That's nearly 18% annual growth.
And when you're generating that kind of cash, you have a lot of options. They chose to reward shareholders.
Aggressively. A 21% dividend increase effective this past June. You just don't make a hike like that without absolute confidence in your business long term.
It's a huge statement to the market, but that strength, that amazing financial discipline, it also brings up the one big question mark the market has faced recently.
Right. As they're showing peak performance, there's a big leadership change.
Yep.
You mean the CFO transition?
Yep.
Ryan Lewata's resignation, which was announced on November 14th. The timing felt curious.
It did.
Do we know if he was the main driver behind these margin strategies we were just praising?
And that's the core uncertainty for investors. The CFO is often the architect of that kind of financial discipline. So a change there, especially an unexpected one, makes the market pause.
Assess the continuity risk.
For sure. But it is worth remembering, this management team has a long history of managing big. Nexa is the key. It's an intelligent water management platform that basically turns a one-time hardware sale, a valve, a regulator, into a recurring revenue stream.
So it's a service. It monitors usage, detects leaks.
Prevents floods in commercial buildings, ensures compliance. It's a whole ecosystem.
So they're moving into that sticky subscription-like revenue model.
Right.
That completely changes the story from a cyclical industrial to a a high-value solutions company.
Exactly right. And they use M&A, mergers and acquisitions, to accelerate that shift. They buy very specific strategic capabilities.
We've seen that with Icon, Josam, Bradley in the past, all targeted to boost EBITDA.
And the latest one, the acquisition of Hawes Corporation, which just closed on November 4th, seems to fit that mold perfectly.
So what does Hawes add to the portfolio?
Hawes is a leader in emergency response equipment. Think eye wash stations, emergency showers for industrial sites. It's a perfect complement to Watt's existing focus on water quality.
So they can go to their existing industrial customers and cross-sell a much bigger, more complete safety package.
That's the plan, and the market is expecting some pretty significant synergies to come out of that deal.
Okay, so the fundamental picture is incredibly strong. Let's pivot to the market. How is all of this translating into the stock price?
Well, the technical momentum is just impossible to ignore. The stock has been a massive outperformer.
It's up 26% over the last year.
And 13% in just the last month. It's leaving its industrial peers in the dust.
That kind of run has led to a pretty big technical breakout, hasn't it?
It has. The price just recently broke, and broke convincingly, above that prior resistance around $265.
Which, in technical terms, is a very bullish signal.
It's a powerful signal. It tells you the trend has shifted, that buying pressure is really accelerating.
Of course, that brings up the big question. Are we too late? Are we chasing an overheated stock here? What do the valuations look like?
It's a fair question. The stock closed recently at $269.84. But if you look at the consensus fair value estimate, it's actually closer to $282.
So even after this big run, it's still trading at a discount.
A modest discount, yeah, nearly 5%. It suggests the market is still playing catch-up to the story here, especially the margin expansion and the Hawes synergies.
Okay, so for anyone watching the charts right now, what are the key levels to keep an eye on?
Well, with the breakout, the next immediate resistance seems to be in that $272 to $277 range.
And on the downside, for support.
Support looks pretty solid in the $248 to $252 range. If we saw a pullback that holds above that level, it would suggest the bigger uptrend is still very much intact.
And what are the momentum indicators telling us? Is this just speculative frenzy, or is it, systematic buying?
It looks very systematic. The stock is comfortably above both its 50-day and 200-day moving averages, which confirms a solid long-term trend.
What about the RSI?
The RSI, the Relative Strength Index, is at 62, which is sort of the sweet spot. It tells you there's strong accumulation, but it's not yet in that overbought territory above 70 where you'd start to worry about a sharp correction.
And who's doing the buying? Is this retail getting excited? Or are the big institutions moving in?
This looks like institutional conviction. We've seen continued net institutional buying in the last quarter, and insider sales have been really limited, looking more like regular financial planning than a loss of faith. The smart money seems to like this story.
So let's look ahead. What are the confirmed catalysts, the actual events coming up in the next few months that could really move the needle here?
The big one, the main event, is the Q4 2025 earnings report. That's scheduled for early February 2026.
And after their track record this year, the market is probably expecting another beat.
Another beat is definitely anticipated, and the guidance they give for the full year 2026 will be watched very, very closely.
And I imagine the Hawes integration will be front and center in that guidance call.
Absolutely. The market will want to hear about synergy extraction. Any sign that it's happening faster than expected would be a huge positive catalyst.
Anything else on the calendar?
Keep an eye on December 18th. That's the deadline for institutional 13F filings. We'll get to see which big funds we're buying or selling, and that can cause some short-term moves.
Okay, so that's the confirmed stuff.
Yeah.
What about the whispers? What's the speculative buzz on the street that hasn't been officially announced yet?
One of the louder whispers is about technology. There's chatter about a potential new smart water management product launch, probably in the first quarter of 2026.
An expansion of that Nexa platform.
That's the idea. It would open up new markets, add more of that recurring revenue.
Yeah.
It could be a big deal for their earnings profile.
That makes a lot of sense. What about geographically? Are they looking to expand their footprint?
Yes, there's a lot of talk about an accelerated push into Europe, specifically rumors that they're looking for new distribution partners in Germany and France.
Which could set them up for a big growth spurt in mid-2026 over there.
Leveraging the tighter European water regulations, exactly.
And then there's always the really speculative rumor.
Yeah.
The takeover talk.
It always comes up with a high-quality company like this, doesn't it? It is highly speculative, but the logic is there.
A dominant player, Best-in-class margins, proprietary tech.
It makes them an attractive, though certainly not cheap, target for a big industrial conglomerate that wants to get into the water space in a serious way.
But regardless of any takeover rumors, the long-term drivers here just feel so solid. It gives a sense of safety you don't always get.
They're structural. They're global. I mean, beyond M&A and their own cost controls, they are just perfectly positioned for these huge secular tailwinds.
Like regulatory pressure on water conservation and quality.
Exactly. The need to modernize aging infrastructure. These trends aren't going away. They mandate the adoption of the exact advanced components and smart solutions that Watt sells. It creates this sustained defensive growth profile.
So to sum it all up, with Watts Water, we've got a company showing incredible fundamentals, powerful technical momentum, and a whole slate of potential near-term catalysts. It really is a rare mix of industrial safety and tech-driven growth.
If we connect this to the bigger picture for you, the company operates in a necessary, highly regulated market, meaning its persistent focus on innovative, recurring revenue platforms like Nexa provides a unique blend of structural growth potential and defensive resilience, regardless of short-term macroeconomic noise.